Welcome to On the Edge. I'm Max Keiser. Time now to go to Bangkok and talk with John Kim, founder and chief investment strategist of Smart Knowledge U.
Thank you, Max. It's a pleasure to be back.
All right, first, your thoughts on the European Parliament voting to accept gold as collateral on loans to EU states, and now an outside force possibly being used to collect Greek taxes.
Well, I think, that would just be inevitable because as you've seen during the first quarter of net central bank purchases, which I believe, I'm not positive, but I believe there are more than actually the last two quarters of net buying by central banks in 2010. We see that, that countries and banks are evolving towards gold as money, even though, they publicly may state it's not. They know it's an asset that they hold that is actually worth something.
Right. Now, getting over to this idea about an outside force being used to collect taxes in Greece. When the euro was first launched back in the early 2001 period, people were saying that, well, there's no central agency to collect taxes on these individual countries, and so it's going to be difficult to keep the euro intact. But what's going on in Greece now is that the country of Greece, the leadership in Greece, has deferred his authority to a European-wide and a global authority, effectively giving away the country's sovereignty to try to get the country people in that country to pay taxes. But what about this loss of sovereignty for Greece? Do you think the people in Greece are going to miss their sovereignty?
Oh, definitely. I think I don't think that the people of Greece really are keen on this idea. But as we all know, it's more what the people in control, the elite, maybe the 1% of wealthiest people in that country dictate, and the rest of the country has to follow. So I don't think you have any country where individuals have that sovereign, that sovereign right and sovereign power to determine what's best for them.
Now let's move on to gold and silver. You believe that the price action in silver in 2011 compares to the action in gold in 2008, and that both are signs of manipulation. Talk about that a little bit, John Kim.
Sure, because in 2008, actually, I noticed since I live in Asia that there are periods of time where gold would rise every day in Asian markets by $8, $9, $10 an ounce. And then exactly at 9:30 a.m. New York time, the price of gold would not only decline, but it would waterfall decline, Max. So it would lose sometimes $20, $30 an ounce in a matter of like 3, 4, 5 minutes. So, we're seeing a huge arbitrage position of gold being anywhere from $35 to sometimes even $50 an ounce higher in Asia. And so I don't think you have any free market where you're going to have that, that big of a, and you have to realize too, I think gold back then, gold today is at 1,500. So gold was trading numerically as far as the US dollar price, like a lot less than. So it was percentage wise, it was a pretty large percentage difference within a 24-hour trading period.
Right. So you've got this arbitrage opening up between gold trading in Asia and gold trading in New York. What about this new gold futures contract that's now trading in Asia? That's only been around for a month or so. Any changes now in the global market based on this new futures contract?
No, yeah, I think it's too early. It only started trading, I believe, May 18th. And even that was just a fraction of the total gold market. So I think silver futures aren't even set to trade on the Hong Kong Mercantile Exchange until July. What will be interesting to see is when they start trading in Chinese yuan. And also, we have to see how those futures contracts, on the daily transactions, how they settle. Are they selling in cash? Are they selling in actual physical delivery? One thing, actually, I'd like to bring up, Max, that I really haven't heard anyone speak of, but when I've looked at the CME daily reports for precious metals and gold and silver, most of the daily transactions now for gold futures and silver futures is not settling in cash, not selling in physical, but it's selling in something called EFP and EFS transactions. So the exchange of futures for physical and exchange of futures for swaps, which is really interesting.
Well, talk a little bit about that. So in other words, they're not settling in cash. We know that they prefer cash over physical because the inventories are drawn down to being nearly non-existent. And they're not settling in physical. They're settling in something else. Talk a little bit about what this something else is.
Well, the interesting thing is with the EFP swaps, the exchange of futures for physical, The laws were changed in 2005 to allow the substitution of ETFs, of gold-backed ETFs like the GLD and the IAU at the time to substitute actually for physical. So I believe, let me see, I wrote it down, that the exchange rule, which is 104.36, they actually allowed as a substitute for physical any commodity they said only needs, or anything that could substitute for the physical commodity, they say, quote unquote, need only be substantially the economic equivalent of the futures contract being exchanged. So it allowed basically paper to substitute for physical. And then actually after they passed that, they passed another law that said basically physical only, quote unquote, must have a high degree of price correlation to the underlying of the futures transaction so that the futures transaction would serve as an appropriate hedge for the related position. So what you have in the EFP and EFS swaps is just an allowance for paper to be traded for other paper. So in other words, like someone that's heavily short silver like JP Morgan or heavily short gold like HSBC they don't have to have the physical. And the interesting thing, Max, is when I actually calculated for May, right? All the daily transactions up until May 27th that settled in cash, physical, EFP, and EFS. So for cash and gold futures up 205,976 gold futures contracts that settled, only 0.01% settled in cash, 27% settled in physical, 78.2% settled as EFP transactions, and 21.50% settled as EFS transactions. So you have 99.72% of all transactions in the gold futures market settling as EFP or EFS. And for silver, it was 0.19% settling in cash, 0.93% settling in physical, 85.39% settling as EFP transactions, and 13.49% settling as EFS transactions for the month of May. So then again, you have 98.88% settling in these transactions. And it's a market change, Max, to how, these transactions used to settle just like several years ago.
Yeah, I mean, this is remarkable, contrast the two stories here. You've got the banks on Wall Street. JP Morgan, of course, is the custodian for SLV, the paper version of physical metal. They are heavily short silver. They've been part of an investigation for rigging and market manipulation, the price of silver in London, along with HSBC. And they're building out their pyramid of naked shorts and market manipulation and fraud as it relates to physical silver. Of course, JP Morgan and Goldman Sachs are part of the global banking system. That includes the IMF, of course, because the IMF is mostly U.S. banks. So the IMF and the folks in Europe are telling Greece that they're making their gold eligible as collateral against the paper loans. So here you have an interesting global arbitrage, if you will. And you can see how the wealth is being confiscated from countries like Greece by just contrasting these two stories. Here the IMF is saying, we'll take your physical gold in exchange for our worthless paper debts that we created on your behalf without your legal right. At the same time, they're saying in New York that we'll accept paper to settle these physical contracts as a way to keep the price cheap for now while we're going on our global sovereignty-destroying spree of imperial conquest. So two stories concatenated together, it should open people's eyes to how this gold and silver price is being manipulated and used to steal gold from some countries and to enlarge the Christmas bonuses of the banks on Wall Street. All right, now getting back to the manipulation story, JP Morgan, of course, opened a vault on the COMEX to store some precious metals, but they're not subject to be audited in any way. Is that just another part of their overall fraudulent market manipulation hijinks?
Yeah, before I get to that, I just want to cover one thing real quickly, Max. The interesting thing is when I believe it was GATA that first uncovered the idea that, or the law change that allowed paper ETFs to be substituted for physical in these EFP transactions that take place on the COMEX. And at that time, some bank apologists or banker shills, whatever you want to call them, said, it doesn't matter if paper is being substituted for physical because these transactions only constitute such a small percent of the daily futures transactions that, it's irrelevant. But now I wonder what would be their rebuttal now that, the EFP transactions, like I said, for the month of May for gold were basically consisting of 78.2% of all the transactions cumulatively in the month of May for gold futures, and for silver is 85%, right? So it's it's the bulk of, futures transactions that are being conducted are these paper for paper possible swaps. And getting to your point about JP Morgan, interestingly enough, JP Morgan was as of the end of 2010 was one of the largest holders of the SLV, and they owned, I believe it was 3.6 million shares. So I'm also wondering if they own these shares to be able to, swap these shares to close out their short position in some of these, shady EFP and EFS transactions that are going on. I haven't fully been able to connect the dots, but the explosion of these transactions and the fact that the bulk of these gold futures transactions and the silver futures transactions are now in EFP and EFS transactions, that should raise a huge question mark.
Yeah, well, as we've talked about on this show many times, the banks are acting not only as brokers but as dealers and market makers, which means that they basically can commit crimes all day long, and when they're found out to have committed a crime, they use the excuse of, well, we're keeping the markets open, and if you pursue that investigation, we'll shut the markets, and so they can commit crimes with impunity. This is why the U.S. system is collapsing. You communicated with Bart Chilton recently regarding what you saw as this manipulation in the gold market. Bart Chilton, of course, is part of the CFTC, one of the commissioners. How did that go?
Well, in 2008, I noticed the huge arbitrage positions that were going on a daily basis between the prices of gold and gold futures in Asia and in New York. And sometimes, as I said, it's quite frequent for those disparities in price, for the price of Asia to be $30, $40, $50 an ounce higher than the price that was determined in New York later that day at market opening of the COMEX in New York. And so when I pointed that out to Mr. Chilton, he responded that basically Asia was manipulating. It was not a free market in Asia, but it was a free market in New York, and that the Chinese were manipulating the gold market. But yet some of the Chinese bankers had acknowledged the fact that, due to certain conditions, the gold market would be higher in Asia than in New York. But they said on average, they determined those factors to boost the Asian market only by $4 an ounce. So we're talking there's still unaccounted for $36 to $40 an ounce higher in Asia. What was accounting for that? And again, the CFT responded to me and said it's primarily because Asia was manipulating, whereas, of course, I believe it's primarily the New York bankers that were manipulating the price downward. So I highly disagreed with that response.
All right, so let's move on to what's happening in rare earth metals. China plans to open a rare earth metals exchange in order, they say, to set the price in China rather than bending to foreign expectations. Of course, China has a huge virtual monopoly in rare earths. Rare earths are the stuff that goes into lots of very popular gadgets around the world, like iPads and iPhones and iPods and things like that. And so what about this new exchange in China for rare earths? What's happening there?
Well, I think, basically it's just it's a power struggle that we see, going on, and China's basically trying to take care of their own citizens because they do hold, as far as the known deposits of rare earths right now, they hold the majority. So they want to make sure that they have, the most influence in setting the price on the market as far as the rare earths are concerned.
Right. Well, it makes sense. Going forward, how critical will rare earths be in the global economy? Will it, for example, challenge oil in some way? Because oil, of course, we know we've hit peak oil, and oil as a component of the global economy will have to subside or diminish in some way. Are rare earths kind of the next major component of the global economy of the century going forward, perhaps?
I don't know. I'm not convinced that it is right now. I know, at various points in time, rare earths becomes the kind of hot asset to get into. But I also know there's been a huge amount of speculation in the rare earths too that makes the price so volatile, up and down. So I'm I'm not really convinced at this point that it will become as important as, say oil and other energy commodities in the future, but it's something certainly to keep an eye on.
All right, let's talk about some risks out there, especially in precious metals. Now, the enemy of precious metals would be a higher interest rate environment. If the U.S. Federal Reserve, for example, were to raise the discount rate, raise interest rates, this would make the dollar attractive and would make precious metals less attractive. The quantitative easing of QE2, is set to expire this month in June. And so what's the speculation? Will there be more quantitative easing? That is to say, more money printing and more in the way of cheap and ultra low interest rates?
I don't know. That's a hard call. I really think right now, though, that the Fed Reserve has kind of put themselves in a place where they're at the point of no return. So, they could certainly stop QE3 to see what happens. But I think if they not engage in QE3 to see what happens in the stock markets. But I think, pretty much if they do that, then the stock market is going to fall quite significantly. So, it's whether they want to continue to destroy the dollar or continue to prop up the stock markets, because basically there's no volume in the stock markets anymore. And for the past, I believe it's about past year, the daily trading volume in the New York Stock Exchange has been falling as the U.S. stock markets have been rising, which shows it's a totally rigged, fraudulent rise. So the only thing that could sustain the U.S. markets, even at the level where it's at, I'm not even saying push it even higher, but to sustain it is you need more QE.
Now, have you been following, up until recently anyway, the story with Citibank stock? Citibank stock was trading under $5, and it made up, you mentioned volume on the New York Stock Exchange. It was 30, 40, sometimes 50% of the volume on the New York Stock Exchange just trading Citibank stock. And it's widely known that this volume of Citibank stock was generated by computer trading from all the Wall Street firms who were creating synthetic arbitrage or arbitrage accounts and buying and selling the stock in ways to scrape pennies from the exchange and to steal hundreds of millions of dollars every single day. The stock then went through a reverse split. We don't see this anymore. But did you follow that particular scam on Wall Street, the Citibank penny stealing scam, while it was active for about a year or so?
I followed it slightly. I was aware of the huge amount of volume that it's constituted of the daily trading volume on the New York Stock Exchange, like composite index. And I think I even remember a day in 2008 where it was something ridiculous, like something like 75% of the daily trading volume for like one day. So I am aware of that, but I haven't really followed the reverse stock split, that closely. But other than the fact that I know that it happened to, I guess, give it a price that makes it look more attractive to unsuspecting naive investors. I guess that was the point of that, right?
Well, they to make it eligible to be owned by institutions, it had to be over $5 a share. All right, well, we've got a couple of minutes left. You believe we are witnessing the death of capitalism. So what are the signs of this?
Well, the fact that basically if you equate free markets with capitalism, I know like a lot of people have been misled about what exactly free market capitalism is, because, you have Alan Greenspan that says that free markets were responsible for the financial crisis. But really, today, I think like all markets are rigged. You don't have any free markets because you don't have supply and demand determining the price of any asset today. That's, a major asset that's globally traded. So you don't have supply and demand determining the price of gold, the price of silver, the price of oil, the price of stocks. So, that's what I mean by the death of capitalism, is that everything is rigged today. Everything's controlled by the top 1% of the banking elite in every country. And, you don't really have the theoretical policies of capitalism at work today.
Yeah, it's become rigged market capitalism. And those who are able to loan money into existence to those suckers in America and around the world who then put themselves into debt slavery voluntarily are laughing. At the end of the year, of course, they take the fake money that they created and they buy themselves real assets like gold, silver, precious art, things like this that actually have real intrinsic value. And this trend is getting worse and worse. And, of course, now I think if you look around the world and you see global uprisings in Spain, Ireland,
sure,
Greece, Wisconsin, Cairo, and Tunisia. There's global insurrection against the banking banking occupiers is gaining ground. I know that the Economist magazine ran a story last year trying to predict which country would seek a regime change first and in what order. And of course, if you extrapolate that, you'd have to ask yourself, at what point is the entire globe going to experience some kind of regime change or global insurrection? Any thoughts on that? Handicapping when we'll see the global insurrection? Will it be this year, next year, ever?
Well, I think actually the turning point you'll see for that, and we are at a tipping point in many nations right now, is when the middle class, as it already is shrinking, when the middle class basically is forced into the ranks of the poor by the banking policies and austerity measures. That's when you'll see revolution, like in every country, is when that happens. Because I think people are kind of fed up that when things don't go their way, then what happens? The bankers just change the laws, right? You saw that in the silver margin hikes recently to crash silver from 50 to 33. Saw that back when the Hunt brothers tried to corner the silver market. They did the same thing. They raised silver margins. They capped, CME capped any individual trader as holding a maximum of 3 million ounces of silver. And I think at one point the Hunt brothers held 55 million ounces. So it's forced liquidation. When prices go too high, they force liquidation. When they talk about implementing position limits in silver right now, the CFTC says even if they do, HSBC and JP Morgan will be grandfathered in with their current short positions. But back then, when things didn't go their way, they said you have 5 weeks, basically to adhere to our laws. So, people are getting tired of just this constant, manipulation and the constant changing of laws to change the laws when things don't go their way. And then their way being the banker's way.
All right, J.S. Kim, thanks so much for being on The Edge.
Thanks a lot, Max.
All right, and that's going to do it for this edition of On the Edge with me, Max Keiser. I want to thank my guest, J.S. Kim. If you want to send me an email, please do so at ontheedge@presstv.com. Until next time, this is Max Keiser saying bye, y'all.